Alright guys, welcome back for another video. In today's video I want to cover a little bit of a psychological topic, and that's the topic of greed and euphoria. In my opinion, these are the two most dangerous emotions any trader can face in their trading career. And they really go hand in hand, right? Euphoria leads to greed, and greed leads to euphoria, but both lead to a inability to perceive risk. And that's why it's so dangerous. People talk about fear and greed often when talking about the markets and the different sentiment that exists in the market. And I often notice that, the topic of fear is typically discussed more often than the topic of greed. But I find that interesting because the topic of greed and euphoria is actually far more dangerous. It's more likely to lead you into the pit or the gutter than fear, right? When you're in a fearful state, typically you are in a state where you're going to be managing risk because you're afraid of losing money, and you're going to tighten up your risk management parameters. In general, of course, it's not always the case, but typically when you're in a fearful state, the fear prevents you from capturing opportunities and prevents you from making money. But the insidious nature of greed and euphoria is that it's kind of the reverse of that, where you're not afraid of, you're capturing the opportunity, but you're also in that state of mind. You're unable to perceive risk, or not just one person, but the human beings in general, right? When euphoria takes hold in the mind, we're not able to accurately perceive risk, and we like the feeling. It feels great. So we want it to continue. We don't want to, bring it to an end out of our own accord. The problem is the market will, if we don't manage our risk, right? The market will turn around, and it will, manage risk for us. Now, it's not really clear why it is that when you're in a euphoric state of mind that your ability to perceive risk dries up. But it is the case. I've noticed for myself personally, any major loss I've had in my trading career, every time it came after a very significant, winning streak. And you get way up, and at least for me personally, and even somebody who would tell you that they know risk management, that they understand risk management, and that they follow it disciplined, you can get into a state where, that all goes out the window. And, suddenly you're violating your rules, and you don't even realize you're doing it. That's why it's so insidious. So, this kind of illustrates the importance of having a plan, right? Because if you have a plan, at least for a way to pull in profit or at least hedge, my opinion right now on the Bitcoin market is that Bitcoin is at sort of a macro bottom, and you can see that by the way the supply distribution is set up on Bitcoin, that you can see, supply is tightening while people are capitulating into that tightening supply curve. Those are typically market bottoms. So hypothetically, in a case where Bitcoin, runs up to, some type of multiple that, not quite the 1,000x that you're seeing on the screen, but some type of multiple that would induce a state of euphoria. It's good to have a plan for that scenario, to write it down on paper, because if you don't write that plan down, then and you make up a plan on the fly, then you're going to be creating a plan that is, forged in that state of euphoria, and it's naturally going to not pull in as much profit, not pull in as much risk as would be needed. So, again, a lot of times when you have a plan, it doesn't feel good to execute it, right? If you'll have your plan, and then you'll still be in that state of euphoria, but as long as you have that plan, it's sort of a visual representation that that is the right course of action to take. And you have to look at that and come to terms with that. And in the back of your mind that plan was created before the state of euphoria was reached. And it just makes it very more readily apparent when you're making the wrong choice, when you have a plan and you actively choose not to follow it, right? As opposed to creating the plan, in the moment when you're in the state of euphoria, it's going to be less clear that you're making the wrong decision there, right? The state of mind that you created the plan in is going to warp your perception about the validity of the plan in general. So this is a good, I guess the moral of the story is just that, euphoria and greed are more dangerous to a trader than fear, in my opinion. And, so if we're talking about risk management, we also need to talk about money management. And money management means reducing the volatility in your trading account, right? Because everybody has a breaking point, right? If you manage money professionally for somebody else, they're going to look at the volatility of your portfolio. And if you're making incredible gains in a very short period of time, they're not going to see that as positive. They're going to see that as negative because they know that volatility cuts both ways. And if you allow extreme portfolio volatility to creep into your trading methodology to the upside, they know it's a double-edged sword, and it will also cut to the downside. But even if it doesn't cut to the downside, just an extreme an extreme burst in portfolio profitability to the upside will also break people's mental constitutions and drive them into a state of euphoria and greed to the point where now their decision making is compromised. So if you're creating a money management strategy, a lot of people consider that the need to minimize downside volatility for obvious reasons, right? You want to minimize your losses. But I think a lot of people overlook the need to minimize upside volatility because the upside volatility can also break mental constitution in the same way that downside volatility can as well. So whenever we're constructing a money management protocol, we need to create it to protect it from ourselves, right? And the idea is that, however evolved you think you are, maybe you meditate every day, maybe you are a very spiritual person, you're not more enlightened than anybody else. The same applies to myself. We're both human beings. We're both operating on the same hardware system. We have the same evolution, the same biology. We are subject to the same software. But so you can never divorce yourself from that, but you can put money management, risk management protocols in place that if you follow them will, keep you away from breaking your mental constitution. And really the moral of the story is keeping portfolio volatility low. And that means taking profit when you're in profit, managing risk when you're in, when you're facing a losing streak as well. And just a quick note on that is that you want these money management principles to, protect you from a losing streak before you even realize that you're in a losing streak. And by the same token, to protect you from a winning streak or the possibility of sliding into euphoria before you even realize that you're in that winning streak. And again, that's going to be unique for everybody, but these type of money management principles, these type of risk management principles that you create, that, in my opinion, that's really where the edge is. It's not really the, whatever lines on the chart you're looking at. That's great. You may have an edge there. But in my opinion, the real edge comes down to the statistical principles that you use to manage risk. And if you can really blow up that portion of your methodology, then you're probably going to really accelerate your development as a trader and really, get to the point where you're going to start having a profitable career and potentially going trading full time. Anyway, I hope you guys like this content. Just leave a like on the video, subscribe to the channel, and and catch you guys in the next one.